What is up, everybody? This is Stock Market Education, and today we're going to be talking about my top 3 REITs that I would invest in. Now, before we get into it, I just want to talk about the definition of what a REIT is. So pretty much what a REIT is, it's a company that owns and usually operates income-producing real estate. REITs own many types of commercial real estate, ranging from office and apartment buildings to warehouses, hospitals, shopping centers, hotels, yada yada yada. Pretty much any company that operates income-producing real estate. The first real estate investment trust that I would buy would be a company called Gaming and Leisures Property, ticker symbol GLPI. And a little bit about Gaming and Leisures Property is it's a company that engages in acquiring, financing, and owning real estate properties to be leased to gaming operators in triple net lease arrangements. Now you're probably wondering, what are triple net lease arrangements? A triple net lease makes the tenants pay for taxes, insurance, and maintenance. So, in other words, it relieves the risk for Gaming and Leisures Property, and it puts the risk on their tenants. And this isn't uncommon for REITs. Many REITs out there use triple net lease arrangements. If you look at Gaming and Leisure's 10K, they have a triple net lease with Penn Gaming that expires in 2028, followed by 4 5-year renewal options exercisable by Penn. So in other words, Gaming and Leisure's Property has another 9 years of income coming from Penn Gaming alone. And if you take a look at Penn Gaming's revenue, you can see that their total revenue has increased every year since 2015. And if Penn Gaming sees an increase in revenues in the future, then they should have no issues paying the triple net lease agreement to Gaming and Leisures. And in addition to that, in April 2016, Gaming and Leisures acquired all of Pinnacle Gaming's assets worth $4.8 billion. Now this is a giant chunk of money for a company like Gaming and Leisures, especially when you compare that to their market cap of $8.5 billion. However, one of the risk factors of the Penn and Pinnacle merger is that Gaming and Leisure's revenues are very dependent on them. So when you go to the risk factor section of the 10K, it says, following the completion of Penn-Pinnacle merger, the majority of our revenues are dependent on Penn and its subsidiaries until we further diversify our portfolio. Any event that has a material adverse effect on Penn's business, financial position, or result of operations is likely to have a material adverse effect on our business, financial position, or result of operations. This shows that Gaming and Leisures is an aggressive REIT due to its little diversification in its portfolio. When you look at the income statement, revenues have gone up substantially while operating expenses have decreased. However, net income decreased, but that was mostly due to depreciation and general administrative expenses. As far as the balance sheet goes, I don't compare cash to debt for real estate investment trusts. The numbers get skewed because these companies take out large loans from banks first and then pay them off over time. However, given that GLPI has an interest coverage ratio of 2.23, they should be able to comfortably pay off their debt. Therefore, I'm not too concerned about the amount of debt that they have on their balance sheet. Lastly, GLPI pays a massive dividend yield of 6.82%. Also, remember never to buy a stock just because it has an attractive dividend. Research the shit out of the company first. The next real estate investment trust to buy is Physicians Realty Trust, ticker symbol DOC. And pretty much what Physicians Realty Trust is a REIT that acquires, develops, owns, and manages healthcare properties. The report later goes on to say approximately 93% of the annualized base rent payments from our properties as of December 31st, 2018 are from absolute and triple net leases. So again, this REIT is putting most of the risk on the tenant and protecting itself from that risk. Physicians Realty is in 30 states with 252 locations and has grown real estate investments from $124 million to $4.4 billion. So this clearly shows that Physicians Realty has grown substantially since its IPO date. And if you look further down into the 10K, you can see this chart of healthcare through 2026, and this makes things very interesting. It says, according to the Centers for Medicare and Medicaid Services, national health expenditure projections from 2017 to 2026, national healthcare expenditures continue to rise and are projected to grow from an estimated $3.5 trillion in 2017 to $5.7 trillion by 2026, representing an average annual rate growth of 5.5%. reaching a projected 19.7% in GDP in 2026. This chart shows that the healthcare industry should continue to grow for the next 7 years. When you look at their income statement, you can clearly see that the total revenue, total operating income, and total net income have gone up substantially over the past 4 years. And their total cash flow from operating activities has done the same exact thing as well. Since Physicians Realty has an interest cover ratio of 1.71, they shouldn't have any problem paying off their debt. And lastly, they pay a very attractive dividend yield of 5.26%. The next REIT to buy is Realty Income Corporation, ticker symbol O. Real estate income is currently trading at 69.99 cents giggity. And one difference between this REIT and the other REITs I have showed is that Realty Income pays a monthly dividend instead of a quarterly dividend. In other words, you get paid every single month for just holding the stock. If you look inside their investor presentation, they show that Realty Income has 261 tenants over 48 industries through 49 states. This clearly shows that real estate income is insanely diversified, making this REIT a low-risk investment. As for future growth, Realty Income is seeking to take advantage of the European real estate markets. The UK has healthy market fundamentals and is estimated for more than $1 trillion in sales leaseback market opportunity. Looking at the income statement, you can see that total revenue and total net income have increased annually since 2014. And although total debt has risen annually, total equity has risen at a higher rate compared to total debt. Currently, Realty Income pays an annual dividend of 3.85%. So, although they pay a monthly dividend, Realty Income is slightly lower than the other REITs that we went over in this video. However, just because Realty Income pays a lower dividend does not mean that it's a bad company to invest in. With that being said, the most important things to look for in real estate investment trusts is their revenues and then their growth strategies. Thank you guys for watching this video. If you liked the video, give it a thumbs up and let me know down in the comment section below whether you loved it, hated it, or indifferent about it. And as always, this is Stock Market Education.